Okay.
Okay. My name is Ralph Abbott, and I am a partner with Prospera Advisory Group. We're a non-bank lender. We do, let me get my slide. No. We're, we're a non-bank lender, so we lend on, we do fix and flips, commercial real estate, short-term, long-term loans in the lending space. So our niche is pretty much when the bank won't do or can't do a project, that's when we come in. So we don't really compete against the banks. If you can get bank financing, um, then that would be the first option to go. If you cannot, then this is where we come in and we fill that spot. We do probably 50% rehab loans and then 50% commercial real estate loans. We either do it on our books or we have wholesale relationships, depending on the size or the complexity of the project. So Pre wanted me to come in and talk to you about kind of what the nature of the lending market is today, because we work with a lot of different banks. We get a lot of referrals from banks. I don't know if that's me. Um, so we always know who's doing what, who's not doing what, how's the market changing, um, and so forth. So just to get a little background on myself, my partner is Richard Adenstein. He's not on the call here, but no, I've been lending for now 25 years. I've been doing nothing but commercial real estate lending. My partner, he actually does investing in a lot of real estate, single family homes, commercial homes. He does his own rehab. Um, so between the two, we formed this company to kind of fill that gap for the investors. Here, right here, I didn't know who I was going to talk to. I mean, we invest in a lot of the Midwest because our economy here, especially if you're in Columbus, is very diverse. I mean, as you can see, people are still selling. We lend in Indianapolis, Pittsburgh, Michigan, pretty much the Midwest, Chicago. We really look for cities kind of like Columbus. So if you're here doing investing in this market, it's a great market. It's good and bad because it's prices are high because it's a great market, and it's bad because prices are high. It's a great market, unfortunately. So what I just want to kind of get into is first start out with the state of the traditional lenders. So kind of if you're looking for financing from the traditional guys, what that looks like right now in this COVID era. Um, so the larger banks right now, they are kind of pulling back, especially on investment properties. We talked to a lot of them, the Chases, the PNC. They are pulling back on their investment property portfolio. Mainly, they're just now looking inside of their own portfolio. So they're not really trying to do, unless you're really a large existing clientele, do any more investment properties. We've heard that many times. But I will tell you though, on the traditional side, the community banks and the credit unions are still actively lending. They're still looking for deals. Um, we sent over Class C office building to a community bank, cash out, which is right now a no-no. They're doing it. So I would say if you're looking for a traditional lender, unless you have a very strong relationship with one of these big lenders, a Fifth Third, the Chases, you probably want to look at a community bank or a credit union. Um, and the questions that now that you're going to have to start to really think about when you go to these lenders is COVID. That's like the first question. That's the first question we ask. Okay, so how's COVID? If it's existing property or one that you're purchasing, how has COVID affected the property? Are the tenants currently paying? Um, if they are paying, they're gonna want documented proof on that they've paid, kind of some kind of receipt, deposits showing that they are paying. And then even after that, what they're also looking at is, okay, what is your liquidity to kind of hold out if they're not paying. So if we've had one, it's an 8 unit and the tenants are paying right now, but everybody's looking, okay, if this thing gets worse, how much liquidity can you have on hand to carry out if 50% of the tenants can't pay or 70% of the tenants can't pay? So the traditional lenders are now doing something that previously we didn't have that issue. We just, hey, I got an 8 unit, want to get a refinance, take cash out or purchase it. They look at the income of the property, the credit score. Okay, fast approval. Now it's more of a deep dive. I mean, they're going to underwrite the tenant mixture. So is it Section 8? Is it traditional? Young people, pretty much all size of the tenant mix. So the tenant, usually on the smaller deals, they didn't get this deep down into your tenant mix. It was usually more on the like 450 unit apartments. Okay, what's your tenant mix? Now they're taking that and even going for the smaller ones and making sure that they're able to pay or they're going to be staying. Because once, I don't know if the moratorium of eviction is up, I think it is. That's also what they're looking at. How many of these tenants are going to be evicted if you're buying or refinancing that you're going to, and then how long is it going to take you to get somebody else in. So that is kind of the new underwriting, the new norm of what we have going on right now. So if you're in that market, be prepared to kind of go in and have those answers up front that you've done your due diligence, because it's going to come down. So I'll make this interactive, but so if anybody has any questions on just kind of like what we're seeing with the traditional lenders, the banks, if you want to jump in, feel free.
Yeah, Ralph, do you envision that those new lending requirements or, a little stricter underwriting, do you envision that that's temporary and that may lift, as COVID is not considered a global pandemic anymore? Or do you think that those new guidelines are here to stay?
I think eventually it's going to lift, but I don't see it lifting this year. It's kind of like if you look back in 2008, everything got tightened up, but then as further we got away, 2 to 3 years, things started to kind of ease out. I don't see these underwriting requirements changing for a year or two. We think that, because right now, what we all kind of think is right now that the government is pretty much propping up the economy. So there's a lot of cash out there, a lot of low cost money. Eventually that has to stop. And then it's going to say, okay, now that this party's over, how's that going to look? So I don't see that changing for 2 to 3 years, because right now, nothing is going to, I don't see any, the opportunities we see is really 2021. Banks are going to be easier on existing borrowers. They're not going to kind of kick them out this year. We got too much going on between this, the riots, election. You're not going to see that kind of push from the banks until next year. So I see that kind of staying for at least 2 to 3 years.
Okay, very good. Thank you.
Yep. Anybody else?
So Ralph, I had a question here. From what you are seeing in the market, is there anybody coming in for refinance? And is it because they fear that they're going to have a lot of evictions?
The lenders, the community bank lenders that we work with and the credit unions, they're okay doing the refinance. It is just really just saying what they're really just looking and saying, okay, this is why they're deep diving into your tenant mix. So they want to see, if you're Section 8, you're pretty well okay because the government pays. If you're not Section 8 and you're just a regular tenant, okay, what are those tenants do? Like what kind of profile are these tenants? Are they, maybe working class, but now their job just got eliminated and they're getting government assistance from unemployment or whatever? Well, how long is that going to last to pay your rent? So depending on like kind of what rent they're in, the Class C, Class B, Class A, they're going to start looking at those kind of tenant profiles. So that's what you have to kind of look into, is what your tenant profile is made of. But refi is still being done. We're doing cash out also. It's just you have to do a lot more deep dive and explanation on this is going to be okay. And then, and granted, everybody thinks that multifamily is still a good investment because we all still need a place to live. It's just mainly how long can you hold out if your tenant mix has to leave, if 50% has to leave or 75% have to leave, unless they're all Section 8. That's when it comes back on you as the sponsor to say how much liquidity do you have to, make the payments until you get a new set of tenants in.
Okay, so are you seeing any new guidelines as far as liquidity goes, or reserves? Are they, you must come in with significantly more reserves than previously?
There's never been like a hard and fast, but like the rule of thumb was always like they like to see 6 months of loan payments. That was kind of the rule of thumb. So as you get a bigger and bigger loan, that kind of starts to push out with the traditional guys. So it might be, hey, I want to see 8 months or 12 months. So it has always had been kind of 6 months. Nobody will say, hey, we have a hard and fast. They just more on, we just want to see it. So we've always just said, hey, you have 6 months of loan payments after that refi or purchase on the side, especially on the purchase. They don't want to see all that cash go into the property and then have no reserves. So especially in the purchase, they least like to say, hey, you got 6 months of loan payments in reserve somewhere. That's accessible.
Okay,
so
very good.
If you're going for just like a refi, if it's just a kind of like a rate term refi, I'd say if you have 6 months of reserves in there, you should be fine.
Perfect. Thank you, Ralph.
Yep. Anybody else? Okay. So then I'll go into, we have the whole other world, which is the non-bank lenders. Those non-bank lenders include ourselves, but I'll start out. There's a section of there what we call kind of the non-bank long-term lenders. I don't know if you've heard of them, like the Velocities, the Silver Hills, the Cherry Woods. Those are non-bank lenders that what they do, their underwriting is different from traditional lenders, where they just underwrite the property. Where you get the difference between the traditional lenders underwriting and the big banks, or just the banks, is they'll look at the property and a global cash flow to make sure that the deal works, where the non-bank lenders will just look at just the property, the cash flow of the property, and your credit scores. Right now, all of them are on the sidelines, mainly because they get their funding by the secondary market. So they originate the loans, they bundle them up, and then they sell it out to the secondary market. That market froze in March. So once the shutdowns started to happen over the United States, that whole market just immediately froze. So all the deals that were in the pipeline that were about to fund, they didn't fund them. They pretty much just said, first they said, hey, we're gonna wait 2 weeks to see if something happens. So we're not gonna say we're not gonna fund these deals, we just needed to wait. And then April 1st, they just said, okay, we're gonna wait till a quarter. So as right now, in April, they said they were thinking coming back in June. Now they're saying, hey, we're gonna wait another quarter. So their whole funding dries up. And that's the good and bad on non-bank lenders. They are beholden to the secondary market. You saw that if you're in the market in 2008, they pretty much all went away in 2008 because nobody was buying the paper. So those guys right now, I mean, because they're much easier to underwrite, much easier to get deals done through them, and much faster. But you usually pay 2 to 3 percentage points higher on a loan amount than a bank when you use them. But since they're out of the market, unfortunately, that moves it kind of down to people like us, the private lenders, also called non-bank lenders, where Now people are just coming to us to say, hey, I just want a bridge loan until either I get this property stabilized or I get whatever the issue would be until I can, kind of get over this hump, because we'll go out 12 to 24 months. And that's typically what the non-bank private lending will go out to, 12 to 24 months. Now those rates are higher. They're typically 4% higher than the non-bank lenders. So you're looking between 10 and 12%. But the purpose of it is really to get you through to when these guys start to open it back up. If you want to go to a traditional bank and the bank tells you maybe your credit score is not there yet, it gives you that time to do that, or the property needs to be stabilized. Like they want to see 6 months of rents payments, and you want to take over a property. That's when you do this. You come to us, take it over, then go out and get it traditionally financed. So in our area, we're seeing fallouts from the non-bank lenders that had deals in the pipeline that's supposed to close, that had to put them on pause and walk away. We're seeing a lot of those deals come through. And we're also seeing a lot of we haven't seen opportunity buying at this moment yet. Just talking to Pre before this, we don't think that we're going to see that opportunity in the real estate market to start buying until probably 2021. Just because there's cheap money out there at this moment and people are still hanging on there, and the banks are probably not going to put any pressure on to anybody until next year. So we haven't seen any really people buying notes or defaulted properties yet on that side. Does anybody have any questions on what we've seen or the properties we've seen?
Yeah, Ralph, what areas are you seeing people buying up right now in Columbus?
We're still seeing a lot of rehabs. So those are still coming into us quite a bit. And they're typically the single family investment home, the duplexes, the small units. We're seeing a lot of those. Now we're seeing those rehabbers that we're seeing, they're doing major renovation. If they want to get to a cost lower than what if you're just going to buy something off the market, they're coming in and kind of taking those properties that are probably a little bit more labor intensive than what we used to see 2 to 3 years ago, where it was more cosmetic. So, they're buying a $200,000 property. They may have $75,000 budget. Now we're seeing, hey, they're buying a $100,000 rundown and putting in $150,000. We have one right now. He actually bought this one in a land bank, and so he got it for $2,000. He put $200,000 into this project, and now he made this one from a duplex to a fourplex. So his value he's gonna make quite a bit of money on that. So we're seeing more rehabbers now come in and say, instead of just doing a straight single family home rehab, they're doing, hey, I'm gonna buy a single family or a duplex, and I'm gonna increase the value by making it either a duplex, because it's a single family home, to a duplex, or like he's doing a duplex to a fourplex. So those are much more run down, but they're like, hey, since I'm down to the studs anyways, I'm just gonna go ahead and split it, put the two in. Some of them are keeping them, some of them are gonna sell it, and they're gonna have a great increase in value.
So you think City of Columbus is not giving these guys a tough time for increasing the density of the property?
They're not giving a tough time. It's mainly that they're just slow to get the permits in place, because when you're using hard money loans, interest is always accruing and it's expensive. So time is a factor of your profitability. So where we used to do terms for 12 months, now we're doing, or not 12, we used to do terms of 9 months, because you should be able, most of them are getting done in 6 or 7 months, put them on the market. So now that's more 12 months, because you're seeing delays of getting your permits. We've seen up to 30 days in some of them. And so, and also the city also likes to change, a nice way to say, they sometimes, say, okay, hey, well, you know what, we changed the code, so now we want you to change this to whatever code because you're doing the rehab project right now. So we see a lot of, when we're telling people to put the budget together, go ahead and make a, contingency in there strong enough to get ready that, hey, well, we had one guy, the city came in, they did architectural plans, got it approved. The city still came back in and said, hey, you know what? We think you need a beam across the basement. Well, that's not in the plans. The architect said that, a steel beam is not needed for support, but the city came in and said, yes, we want this. That's an extra $10,000 that they weren't thinking that they needed to do. So it's like, are you going to keep fighting the city, or are you just going to put it in and get the project moving? So that's the kind of things that we're seeing on that.
Hey, Ralph, I've got a slightly off-topic question,
Okay.
but what size of, you mentioned you guys do a lot of commercial lending.
Mhm.
What size of, loans for new acquisitions do you guys originate up to? What size?
We don't have our is mainly minimum. The minimum loan we like to see is 250,000.
Okay.
Size wise, up than that, there's really no ceiling. We've looked at $10 million deals. We've done $4 million deals. That size of it really doesn't. We don't have a size limit. So I mean, I mainly say what we look at is really the property type on the commercial side. Special purpose properties, that's not our forte. They're harder to get done, especially in this new environment. If you don't know what a special purpose property is, think of like a hotel. If you have to take a hotel back, it's a hotel. It's hard to change it to something else, or a gas station. Those things right there are special purpose. I'm not saying you can't get it done. It's just much harder to get done. What else we're seeing? So construction right now, we're seeing a lot of people pull back on construction at this moment. I think that's just going to be a little pause on the construction side, but right now they're pulling back. So the commercial, any size, it's just really the property type, what it is. Retail, if you're looking to buy like a retail space, they're tougher right now, depending on what your tenants are in there with, because it'll go down to same as like multifamily. If you have a tenant mix that are kind of the mom and pops, that's probably going to be much harder because, once again, are these businesses open? Are they paying if they're open? Are you deferring the rents so they stay in, which then means that the cost of payments and the property taxes are going to be on you, the owner, and can you support that?
Another off-topic question. Are you seeing a lot of out-of-state investors coming in right now? And I would be more interested in, say, California, because of the new laws that are being passed there.
Yeah.
That will frighten away a lot of investors from there.
We always saw a lot of California people invest here because our cap rates are much better than California. We haven't seen a necessary increase right now. I think there's definitely going to be a lot of out-of-state people come in because either we see them from the West Coast and the East Coast, kind of like New York money and California money. I think we're going to get another wave of those guys, but they're all kind of waiting for that market dip. So everybody's kind of saying, hey, we believe there's going to be opportunities out there, so we're just going to wait. We've talked to other investors that do that, and they're pretty much holding cash. They're really just sitting on cash and saying, we think there's going to be this opportunity of waves of things that we can get for cheap for the properties that are over leveraged, or the owner doesn't have a deep pocket to keep the property if their tenant's not paying. we know we can kind of get in there and get this thing, at a discount. And so right now they're all kind of just waiting on the sideline, and they're just building up their dry powder of money. But if you start getting those investors are hungry, and they're hungry and they have money.
Yeah, I'm thinking California is going to start coming in shortly, just because there's a new law that's being passed there, where businesses can now claim hardship under the stay-at-home orders
Yeah.
and break their leases.
Oh yeah.
So if that law goes into effect, I see a lot of investors dumping their properties there and
Right.
come to states like Ohio.
Right. Because and compared to some states, Ohio actually done quite well in that we have some deals in Indianapolis where they expanded the deferment. Now you can't evict or foreclose until now July 1st. And we don't know if that's going to even be extended even further. Columbus just did until I think now June 1st. So, but those are kind of the different things too you got to look at if you're buying out of state, at least, like what's their new deferment laws or foreclosures or tenants being able to not pay. So though we also see that in New York, because we're watching the investors saying, especially on the commercial and on the multifamily, I think New York's extended their eviction to July, or if not further. And so nobody, I mean, if we're all in the investment real estate side, that's a trickle down effect. If I don't get paid, well, property taxes are coming due soon here, I think in July. How am I going to pay the property taxes? Or if I'm paying utilities and all those expenses have to come out of something. And if I'm not getting the money from my tenants, it's coming out of my pocket. So you probably also will see some of these investors who don't want to deal with this anymore start dumping properties too. So I mean that's what we're looking for. We're looking now at hopefully like fourth quarter, where some of these guys are just going to say, hey, I'm done. I don't want to deal with this. I don't have the money to now pay property taxes, and other fees that might be coming out. So that's another opportunity areas if you're looking to buy, that we think that we'll see investors come in and swoop in, and then especially if you're a cash buyer, come in, get that property at a discount. That's an opportunity right there. And that's probably why also, everybody's sitting on cash on the East Coast and the California people too, and come in with those guys.
Ralph, I apologize for getting in here a little bit late. You might have answered this question already. My question is more towards 6 to 10 unit multifamily refinance. What options are you seeing out there for that stuff?
On the traditional side, we see, and we've worked and sent people to the community banks and the credit unions. The larger banks, unless you have a very strong relationship, they've been pulling back on investment properties. And honestly, they've been pulling back on investment properties actually before this, but they're pulling back. The community banks have not, and the credit unions have not. Now, the underwriting is a much deeper dive into that. It's more like, it could be even 1 to 2. It's all a deeper dive for all kind of new loans, no matter what. So what they're just saying, we just had a guy, he has, what is his, how big is this unit? Oh, it's probably a 300 unit facility, doing a cash out right now, which right now everybody's like, cash out, no way. They're doing a cash out, and the question that you just have to answer going into it and make sure you have your documentation and your answer is, all right, your tenant mix, your tenant profile, are they Section 8? Are they market rents? make sure what that is. Are they paying right now? How much are they paying? So, maybe you're like 95% occupied and 80% are paying. That's still a good number, because then they could say, okay, so what they're doing is now they're stress testing, okay, market rent, 80% doesn't pay. What's my break even on that? So they're just going to go, okay, here's my loan amount, here's my break even for 1-to-1 to cover the expenses of who may not pay. And then 2, what they're going to say is offset that to you, to the sponsor, to say, how much liquidity do you have if 30% are not paying? That's your break even. And can you cover that as you are evicting and kind of putting new tenants in to start paying? So the market is still very strong on the lending side for those, because it's still one of the favorite lending types, because we know people still need places to live, and Columbus has a housing problem already. So it's not really about the product, that particular property type. It's just more about how long can you hold out, and what's your break even at this point with COVID.
Okay.
So, I mean, the best property type going to get a loan is still multifamily.
Okay.
Single family investment home to multifamily, because we all know there's not an overabundance like in 2008 of properties. So it's still a great investment, or at least getting loans on. They still love it.
And you're saying that the private lending, though, in that aspect is dried up, and that so you're basically going to be forced to go full doc on
Yeah.
anything.
Okay. Yeah. I was, that's my next slide. Honestly, like the stated, because eventually I do think the non-bank lenders and non-bank lenders are going to come back into the market. When? Fourth quarter, maybe next year. They've already said this third quarter, they're not, as of right now, they're not doing anything. But when they come back, just like they did in 2008, I think that no doc loan, Silver Hill used to have, I think that's going to go away. Light doc, that's going to be going away. They might call, I think pretty much everything's probably going to be full doc. And whatever they're going to call, they're going to give some kind of spin, but at the end of the day, it's going to be a full doc right now when they come back. And then what they're going to also do is they're going to cut back the loan to values. So where they used to maybe do 80, is going to be 75 or 70. If you want cash out, it's probably going to be 60, 65%. It's kind of the same story. We've seen this in 2008. They first all left, and when they did come back, it was all full docs. And pricing probably higher on that side.
And so in that instance, for an investor who's continuing to grow every year, and obviously with our tax situation, with writing things off like that, it's just going to be extremely hard to get anything like that underwritten.
Under that side. Well, I wouldn't say it's hard for you guys to get it done on the full doc side. I mean, it's much easier to go through the non-bank lenders, because they just look at the property. You don't have to worry about everything else. You just have to be, you have to educate the lender. Because one of the problems is if it's too hard, like even when we take a deal into a banker, and I'm an ex-banker and credit underwriter, we know that I have to pretty much make this very simple and almost, I don't want to say pretty much do the job for them, but do their job for them. Here's the cash flow, the things that we're writing off, those are add backs. You can see all that. Here are the property types. Like, it's almost like you need to come in and just, if you want to make your life easier, come in with all the information, and then write it all down. So when they go talk to their credit people, they can explain it, because they have to turn around and sell it internally. And if they don't know it and it's too difficult, it's just easier for them, the credit person, just to say no, because they don't want to spend time to understand it. So that's kind of have to probably be your kind of new world, is to go in and just say, let me walk you through, let's get on a conference call and I'll walk you through my financial statement. We've had to do that with a guy. he actually already has a relationship with the bank, and they've already done like $3 million with them. We have a conference call set up with the credit person to go through the tax returns, explain to them, this is this, that's a write-off, that's a non-bank write-off, non-cash write-off. Like, we're going down deep into it so they can understand it. And they already have the relationship with them. So I think this is just, that's going to be the new reality at this moment. So just because you're investors and you're growing, you still can get financing. It's just going to be a longer process. Anything else?
I'm not sure if I missed that earlier on. So what are the terms of your loan? And do you have a minimum?
So depending on what you're looking for. So our rehab loans, we will go up to 90% of the purchase, 65% of the ARV value. We'll fund 100% of the rehab. Now we'll change those ratios depending on how many projects you've done. And then the terms are now 12 months. We'll go up 12 months. It's interest only. And we start at 12% and 2 to 3 points on the rehabs. And then all those will change depending on, so what we look for the underwriting side of it is we look for liquidity. Because your most important part of all rehab, and the most important that actually gets everybody in trouble, is the budget. So we put in a contingency. If you don't put a contingency into your budget, we'll put it in. We've seen so many people go in, walk through the property, hey, here's my line item. And that's also one of the things that we see a lot, where people just give us a budget. We require a line item budget, so we know what we're expecting, and when the inspector comes out for our side to reimburse you funds, what they're looking at. But that budget should probably be the most you spend time on, because we've seen so many where they just gone on a budget, kind of like the beam, we put a contingency in there so we're fine and didn't have to come out of pocket, because if you go over budget, you're gonna have to come out of pocket. So that is probably the number one thing that we see where people get stuck on a rehab project. Our minimum on the rehab is $100,000. On commercial property is $250,000.
Thank you.
Anybody else? I think we can move on.
Well, I mean, I can go on and talk about. Here's my contact information, and Richard's too. So if you have any questions, feel free to email me, call me. I don't want to say we've seen everything, because every time I say that, I'll see something and say I've never seen that before. But we've seen a lot. We've gone through this in 4 cycles now: 2001, 2008, and now here. That's 3 cycles. So we've seen this over and over, maybe not on this scale, but at the end of the day, it's kind of the same. If you don't have capital in the market, if capital dries up or the real estate goes up and down, we always give you opinion. And like I said, we always work, and we know a lot of the bankers here. So we spend half our time to see what they're doing, what their portfolio is, what their appetite is. Because when we're doing a project, especially in a commercial, we want to also have an exit. So we want to know what that bank and what the different banks are doing, and how it works into what their underwriting has changed.
So what's your timeline? I mean, how long do you take to process?
For our loans?
Yes.
So for our rehab loans, for all our loans, we like to close in 30 days or less. So from the time that we issue the term sheet, we want to close in 30 days or less. Appraisals are typically, on the residential side, a week to 2 weeks. Commercial, probably 3 to 4 weeks, depending on the size of the project. Really what slows us down is really collecting the paperwork from our borrowers. That's really to slow down. We give you a checklist, you know, it's try to get it as quickly as possible, because if the goal is to have the closing checklist done before the appraisal is in. Because we'll order title, we'll order appraisal all at the same time. And so we like to turn around very quickly. Because we want you to also get started quickly, because we know that there's different selling cycles. So if you're buying in the fall, we want you to be rehabbing in the fall so you can put it up in the spring. If you're buying in the spring, we want you to be, you know, rehabbing here to get ready for the, hopefully before school goes back in to sell. So look at those different cycles, and that's why we want to move quickly for us and for the borrower.
Do you have an example of your checklist, Ralph, on a website or somewhere that we could access?
We don't, but I can, if you email me, I can send it to you, because it's also on our application on what we require and the checklist and everything. So if you email me here, I'll shoot that to you.
Okay, thank you.
Send it to me.
Okay.
I can circulate to everybody who's on here along with your contact information.
Okay.
That way they have the checklist and they can call you.
Yeah, I will do that then. I'll send that.
Yeah.
Because our application is
Send it
very,
to William's email. You can send it to him too. You can CC him.
okay. I will do that.
So quick question on the commercial side.
Mhm.
So you said you can go up to 24 months.
Yes.
So what happened at that time? Do you come in and help them or guide them towards a traditional lending when it's time to refinance?
Yes. So
What role do you play?
we don't have a prepayment penalty, so we'll give you up to 24 months. Really, we want you 6 months to 12 months. We really want you to be able to refinance. So when we're looking on a commercial deal that we're going to keep for that long, we're also looking for what the exit strategy is. That's why we also talk to a lot of banks. So we know, okay, this is what you have to fix. If you can fix this, you should be able to get out in 12 months, because you're gonna have to have tax returns done on that property to get refinanced out. So we can help you, get out. We don't want to take back your property. We're not interested to lending to own. We just want to turn it and really turn and burn to get you in, get you out, and to a long-term lender. And we also do that for the rehabs, because sometimes we have some rehabbers who doesn't want to sell, they want to refinance and then rent it out. So we work with a lot of, once again, what bank is doing what can you qualify? Can you do residential loan? Or if you got too many properties, okay, now you're commercial. Who's doing single family investment homes? Because sometimes banks are hot and cold on a portfolio loan of single family investment homes. Some of them are in, some of them out. They kind of go back and forth. But on the non-bank lending side, I will say the single family investment homes are still financeable on the non-bank lending side.
Hello?
Yeah, Ralph, one more question is, how many slip through the cracks and you actually end up financing, but they cannot complete the project in general?
We have not. We only had one project. Well, we had one project that we had to lend more to complete the project, because for us and for you to get the value, the project needs to be completed. So, and this is honestly, this is why we do this. We require you to have the line item budgets. And so when we were part of our underwriting, we would review that budget. We have the appraisal person come in and review it. So sometimes we'll get a budget and then they'll come back and say, yeah, that budget is $20,000 too light. So we will use that budget to say, that's the budget that we're going to go off of. So the second thing is, for the newbies, we really, unless you are like a contractor yourself, and we've had those guys where, hey, I'm a licensed contract, but it might be my first rehab, that's okay. If it's somebody just like an investor, we want you to have a professional contractor, because the things that we've seen that always go over budget are the people that, hey, I want to do it myself. I'm going to manage all these subcontractors and so they always seem to go over. And then right there, that's money out of your pocket. So we've had one, and we typically don't lend. Like, so at that moment we stop. So that's why we also look at and say, you know, we want to see what you have in, once again, in liquidity to cover the overages. So we just had one property where we had to come in and pretty much take it over to get it completed and put it on the market. It's not what we want to do, but that one was a situation where had a contractor, both the borrower and the contractor had a falling out, so he had to go get another contractor. The contractor did half work, and it was just a complete mess. So we've had people where they've come out a significant amount of money for themselves because they didn't do the budget right. And some of it is not even their fault. Some of it, like, you know, the city came in and said, hey, you got to put this beam in that you didn't think you had to put in and you shouldn't have to put it in. But that's another $10,000. So that's also why we put contingencies in there. So I would tell people you should just come in before you even, you know, whatever lender you're going to use, put a contingency into your budget. And if the older the house, the higher the contingency, because usually it's like 10%. If the house is old or run down, I'd increase that to 20%. You never know when you open up that wall. Knob and tube wiring, can't pass code. Inspector's going to come in and say something that they want that you didn't budget for.
Anybody else? Any questions?
Maybe one more quick question, Ralph. Do you lend specifically in you know, certain geographical area, or do you guys, you know, lend all across the U.S., Ohio?
We have the ability to do the U.S., but mainly our loans are in the Midwest. Just the natural of our referral sources are here in the Midwest.
Right.
But we
Okay.
nationwide. When we're doing nationwide or anywhere else, we stick to the major cities. So we won't do anything rural, but, you know, we'll do Cleveland, Columbus, Cincinnati, Dayton, Akron. We won't do like a Mansfield, the smaller towns or the rural towns, because an economy that's like this, those are harder to turn than if you're in a Columbus, Ohio.
Right. So primary and secondary markets.
Right.
Typically.
Yeah.
Okay. Excellent. Thank you.
And honestly, most of the lenders are kind of the same way. Some of them used to do any location. They started to pull back even before COVID, and I'm assuming that they're going to pull back even more and stick to those major suburban areas around the major cities.
Right.
Okay, so last chance if anybody wants to ask Ralph something.
Like I said, you can call me or email me, and I will be glad to answer any questions you may have.
Okay, Ralph, thank you so much for your presentation. I think we all learned a lot today, especially the changing market. So I will forward everybody your information so they can contact you directly, and, you know, good luck to everybody.
Yes, I'll send you our checklist and our application, which has it.
Yeah, I think there's somebody.
Yay. Excellent, excellent information. Thank you so much for your time.
No problem at all.
Thank you, Ralph. Have a great day.
Yep, you too. Thanks, Bree.
Thank you.
Thank you.
Thanks a lot, everyone.
Okay.
Bye, everyone. Have a great weekend.
You too. Bye.
Bye.